Who pays your loans when you die? Most people expect a clean ending. Accounts close, balances disappear. Everything resets quietly, like a system shutting down without leaving traces behind. That expectation feels logical. It's also inaccurate. Loans don't end in the way most people imagine. They enter a process. Not an emotional one, not a moral one, a structured one, defined long before anything actually happens. No one pauses the system to ask what seems fair. No one checks intentions or personal circumstances. There is a framework already in place, and once triggered, it simply begins to operate step by step. Not all debt behaves the same. The word debt sounds simple. It suggests a single category, something uniform and predictable. In reality, it's a collection of completely different mechanisms that only look similar on the surface. Credit cards operate under revolving terms, with flexible balances and compounding interest. Mortgages are tied to assets, with structured repayment and collateral attached. Student loans often come with unique conditions, sometimes involving government programs or specific protections. Two obligations can look identical in amount, yet behave entirely differently once the system takes over. The difference isn't visible in the number, it's hidden in the structure behind it. Think of it like a network. A better way to understand this is not as a list of debts, but as a connected system. Imagine a network of nodes and links, where each loan is connected to something else. Some links connect to assets, some connect to people. Some exist independently but still follow predefined routes. When one central point is removed, the system doesn't stop functioning. Instead, it redistributes the pressure across the remaining connections. What once depended on one person now shifts toward whatever is legally or structurally tied to it. Nothing disappears. It simply moves along the path that was already defined. When payments stop. At a certain moment, activity changes. Access can become limited. Accounts may require authorization before any action is taken. Institutions begin verification processes that slow everything down. From the outside, it can look like nothing is happening. But internally, systems are updating. Interest calculations continue based on existing agreements. Statements may still be generated according to schedule. Deadlines remain in place, even if no one is actively responding yet. This creates a gap between perception and reality. What seems paused is often still moving, just in a different layer. Where responsibility goes. This is the point where most expectations fail. A loan doesn't require the original borrower to remain present in order to exist. Responsibility follows agreements, not relationships. If a cosigner exists, responsibility can shift in that direction. If an account is shared, obligations may already be distributed. If neither applies, the estate itself becomes the point where everything is evaluated and resolved. In some cases, multiple pathways exist at once, and the system determines how they interact. This isn't decided in the moment. It's determined by what was set up earlier, often long before anyone considered the outcome. Why it feels confusing. From the outside, the process lacks visibility. There are no clear signals explaining what is happening step by step. No alerts that translate complexity into something easy to understand. Instead, everything unfolds through documentation, verification, and administrative procedures. Paperwork moves. Records are checked. Decisions are made based on predefined criteria. Because most of this happens behind the scenes, it creates the impression that outcomes are random or inconsistent. In reality, they are highly structured, just not transparent to those who haven't prepared for them. Different outcomes, same situation. Two nearly identical scenarios can lead to completely different results. Same loan amount, same type of debt, same general circumstances. Yet one resolves quickly and cleanly, while the other becomes prolonged and complicated. The reason isn't luck, it's configuration. Small differences in documentation, account setup, or legal structure can redirect the entire outcome. What appears minor at the beginning can become decisive later. What about small debts? Smaller obligations are often treated as insignificant. They receive less attention, less tracking, less urgency. That makes them easier to overlook, and overlooked items tend to create the most disruption. A minor balance can delay larger processes. A forgotten account can require additional verification. An untracked obligation can resurface at the worst possible time. Size doesn't determine impact, visibility does. Now, add time. Nothing in this process happens instantly. There is always a period where things are being reviewed, verified, and processed. Sometimes that period is short, sometimes it extends much longer than expected. During that time, changes continue to occur. Balances adjust according to terms. Records update as information is confirmed. Decisions depend on timing as much as on structure. Delays are not neutral. They influence outcomes. What happens early can differ significantly from what happens later. A more useful way to see it. Instead of thinking about disappearance, it helps to think in terms of movement. Every loan has a direction built into it. Every agreement defines where responsibility goes under different conditions. When one point in the system is removed, that direction doesn't vanish, it continues. The flow simply redirects along the path that already exists. Nothing is improvised. Everything follows design. What determines the outcome? Several factors shape the final result. Documentation defines what is recognized. Account structure determines how responsibilities are linked. The type of debt sets the rules for how it behaves. The presence of other parties introduces additional pathways. Timing affects how quickly and smoothly things resolve. None of these factors operate in isolation. They interact, often in ways that aren't obvious until the process is already underway. The pattern behind it all. Across different situations, one consistent pattern appears. Obligations don't disappear. They move toward resolution. That resolution can take different forms depending on the setup. Some cases are straightforward and predictable. Others require extended time and multiple steps. But the underlying principle remains the same. The system follows what has already been defined. And here's the part most people miss. Preparation has more impact than magnitude. The size of the loan matters less than the clarity of its structure. Clear arrangements lead to smoother outcomes. Unclear arrangements create friction. Friction leads to delays. Delays increase complexity. Complexity affects everyone involved. This chain reaction is rarely visible at the beginning, but it becomes obvious later. So, who pays? There isn't a single universal answer. Different structures lead to different outcomes. In some cases, obligations are handled through the estate. In others, responsibility shifts to another party connected to the agreement. In certain situations, the obligation may not continue at all. Each result depends entirely on how everything was arranged beforehand. Not on assumptions, not on expectations, on structure. Final thought. At its core, this isn't just about loans. It's about systems operating exactly as designed. Systems don't interpret intention, they execute predefined instructions. Once activated, they follow those instructions step by step, without deviation. Which means the outcome is rarely decided at the end. It's decided at the moment the structure is created. And everything that follows is simply the system doing what it was built to do. Subscribe if you like this video and give me your thoughts in the comments.